In this week's video, we'll review the latest charts and data to help us answer the question, is the stock market bubble about to burst? We'll be moving quickly, so feel free to use the pause button on your video player. Stock market's moved a long way recently, and some of our positions have near vertical charts, thus it's fair to ask and answer. Are we starting to see some things that tend to contradict the demographic and secular trend thesis? S&P 500 1953 to 1974, the move from point A, lower left-hand corner of your screen, to point B in the upper right-hand corner was 429%. However, since interest rates, inflation, and Fed policy were a big part of the equation in this window, there was a lot of volatility between point A and point B. So let's review some charts to help us better understand. In the present data, we look more like one of the blue boxes, favorable periods, strong trending periods within the context of a secular trend. Do we look more like an orange box where we're starting to roll over or correct in a meaningful way? Or are we starting to morph into something after some of these vertical moves that's telling us we should be concerned about the red box and a serious drawdown? And all of this can be helpful because if we review facts and hard data and understand volatility within the context of secular trends, the average drawdown between 1956 and 1968 in a secular trend window was a little bit over 14%. In the 1989 to 1999 window, another secular trend window, the average drawdown was 10.68%, the median just a hair under 10. Thus, within a context of a secular trend, it's not unusual to see 10 to 12% drawdowns, which can make it much more difficult to navigate between a point A and a point B that could be several years down the road. We're all human. When we see vertical charts, look at the chart of SMH, the semiconductor ETF, look at the chart of NVIDIA, it's natural to get concerned. So we want to make sure that the data on the left side of your screen and the concepts on the left side of your screen don't interfere with the concepts on the right side of the screen. And we also want to make sure that we're not drifting into something that looks less and less like a secular trend and more concerning relative to extremely large drawdowns. Lower left-hand corner of your screen, S&P 500 monthly using moving average envelopes. In 1990 here you can see a bout of weakness, then a reversal in late 1990. The moving average envelopes help us monitor the strength of the longer-term trend in this case. So this is what a shorter-term topping process and correction looks like, and this is what a devastating bear market looks like. Thus, in June of 2024, we can ask and answer, does today look more like this concerning rollover process up here, or more like this strong trending period in 1995, or the period in 1991 after this pullback? We'll start with the drawdown in Q4 of 2023. See, we have a favorable turning look on the same chart here, and then we came back to the moving average envelopes and held. Chart on your screen is dated Friday, June 21st at 11 a.m. Eastern Time. And it's fair to say the present day looks more like this window in here after the drawdown in 2015 into early 2016. Present day up here, upper right-hand corner of your screen, looks more like this period in here following the bout of weakness and significant drawdown in 2011. In each case, we have a consolidation box, the moving average envelopes and price improve, consolidation box, the moving average envelopes and price improve, consolidation box, the moving average envelopes and price improve. And if we were to compare June 21st, 2024, upper right-hand corner of your screen, to the 1989 to 2002 window, it's fair to say the present day really doesn't look anything like this concerning rollover period in here, including 1999 here. Look how many times price comes back into the moving average envelope before really bad things start to happen. This is not what we have on June 21st. This looks like a confident and strong trend look. As always, the commentary is based on the charts in front of us. Since the secular volatility model uses a weight of the evidence approach, very similar concepts here. Monthly moving average envelopes, different settings. This is the peaking process in the year 2000. This is the troughing process after the bear market was over. The market bottoms in October of 2002. You'll see this 1998 to 2002 window looks very similar to the rollover process in 2007 before the devastating financial crisis bear market. A trend is a trend is a trend. The combination of the fundamentals in this window here are significantly different relative to the combination of the fundamentals in this window here, yet the charts and trends look very similar. It's because the trends are based on the net aggregate opinion of all market participants regarding all subjects on all time frames. So how does the same chart look today? We've seen some concerning cracks like this or this. This is the chart that we reviewed in August of last year, and you can see when the weakness started, it was occurring above a favorable turn-up look on the moving average envelope. This region down here in 2023 looks similar to this region in here in 2009 and similar to this region here in 2003 after the major low. So if we fast forward to the present day, are we starting to see some concerning cracks like this in here? The answer is no. Again, we have a strong trend look with price well above the moving average envelopes. And it should be noted here, when we covered these charts in early August 2023, we did get a fairly significant drawdown in this window. But that's not the point of the charts. We're trying to understand the longer term trend because we know, unfortunately, drawdowns are a fact of life in the stock market, even within the context of strong bullish trends. A 3% drawdown occurs on average 7.2 times a year. A mild 5% correction, 3.4 times a year. 10% correction, about once a year, and 15%ers in bear markets occur much less frequently. And once again, even though the fundamentals in the window on the right side of your screen were significantly different relative to the fundamentals here and here, the rollover process in 2022 here looks similar to this rollover and similar to this rollover, just as the positive turn looks similar to this positive turn here and this positive turn here. These are weekly moving average envelopes. This is calendar year 1956. This is within the context of a secular trend into 1968 in the upper right-hand corner of your screen. You can see most healthy price action takes place above the moving average envelopes. And when there are significant drawdowns in this window, price tends to make a stand relatively close to the moving average envelopes and doesn't stay below it for anything longer than a few weeks or a few months. In your stronger trending periods, price tends to be above the moving average envelope, and the slope of the upper and lower portion of the envelope tend to be favorable. If we look at the exact same chart today, that's basically what we have. A relatively short stay below the moving average envelope in 2022, and we now have what looks like a market that's trying to reestablish the longer-term trend. Price well above the moving average envelopes, and the slopes are starting to turn up. Chart on your screen dated June 21st, 2024. Similar concepts, different settings. Again, weight of the evidence approach. Looking at multiple time frames. So drawdown, weaker trend period in here. This is what a very strong trend looks like in 1995. Upper right-hand corner of your screen is the look that we want to avoid. Price below the moving average envelopes, the slopes are down. Contrast this look with this look here in 1995. Let's look at the same chart in August of last year. It was helpful. When we had the drawdown in the summer and into Q4 of last year, it was occurring under favorable conditions from a longer-term perspective. May 2023 here looks significantly different from the concerning rollover look here. And this says the trend on this time frame is in doubt, and this says the trend on this time frame is most likely trying to reestablish itself. If we look at the same chart during the session on Friday, June 21st, you can see price came back to the moving average envelope near the low in October and held, and we're back into a favorable and strong trending look. You can see this correction in 1984, the 1987 crash, the pullback in 1990, and this relatively tame pullback in 1994 in terms of the strength of the trend, all of those look significantly different relative to the rollover period up here in the early stages of the dot-com bust bear market. This is a concerning window in here, an improving window, an improving window, improving, and improving back here in 1982. If we look at the same chart today, it's noteworthy that the longer-term trend showed signs of improvement following the low in Q4 of last year. This is the look on June 21st. So compare and contrast the chart with the same settings here in the present day with this favorable turn here in the 1982-1983 window, this favorable turn here in 1989, this favorable turn here in 1994-1995. All three of those periods highlighted in green really don't look anything like this concerning period up here. And all three of the green periods, it's very similar to the favorable turn that we had in October of last year. And the present day here looks stronger than this window in here. Remember, technical analysis is about identifying subtle shifts on charts, because the subtle shifts on these charts help us identify subtle shifts in human behavior. Notice during the strong trending period in here using daily moving average envelopes, this is 1995, 1996. Look how long we go with price never touching this bottom envelope down here. Contrast that very early in the devastating dot-com bear market here. This is the end of the year 2000. From this point here with this ugly look, and this doesn't look anything like this, the stock market drops for basically 2 more years. And the drawdown in the S&P 500, again, approximately 50%. The drawdown in the NASDAQ, much worse. And if we look at this window here in 1990, before this drawdown here, the second leg down in 1990, price comes down and tags the lower moving average envelope 3 times, indicative of a very hesitant trend. Contrast that with the pullback here in 1996, where there's white space between price and the lower portion of the moving average envelope. Same thing in 1997, same thing in late 1997. If we look at the same moving average envelope in August of last year, you can see the envelope was starting to turn back up, telling us to try to be patient if the market came back in this direction. And of course, that's exactly what happened, but price made a stand with some white space between the low and the moving average envelope. So you can make an argument that October of 2023, from a trend perspective, looked more like these favorable windows in here relative to this more concerning window in here. And again, if we examine the same chart using the same daily moving average envelopes, we can see we really don't have a lot in common up here. Price well above the moving average envelope. This really doesn't look anything like the rollover period here in early calendar year 2022. So if we look at the chart over here, right now it looks like one of the stronger trending periods. There's white space in here in 1995 between price and the moving average envelope. We've had that type of white space since November of last year, indicative of a still strong trend. And you can see the similar trending concepts on this highlighted version of the chart with the same settings. This is what a sharp correction looks like. This is what pullbacks look like. And this is what a devastating bear market looks like. And you're focusing on price relative to the moving average envelopes and the slope of the upper and lower portion of the envelope. Similar concepts, much longer term time horizon here, monthly moving average envelope, S&P 500, you can see price makes a stand in 1984, 1987, 1990, and 1994, which is significantly different from what we saw here in late 2000 into early 2001. We look at the same chart today. Did the market make a stand in the rearview mirror in a manner that looks like a strong secular trend? Or do we have something more like this on this time frame that's more concerning? This low here on the monthly chart in 2022 and this low here in October of last year fit in very, very nicely with the secular trend script. Never came down to the lower moving average envelope, during the bear market, and we came back here close to the upper band here and held. This type of look with the band and price looks a lot like this window in here and really doesn't look anything like this up here. The charts that we have here in isolation, I would have to say they're not particularly helpful at all. But when you take a large number of charts using different indicators and different time frames and different concepts and ask numerous questions, then the weight of the evidence starts to become very, very helpful to understand the market's present-day risk-reward profile. A week ago, trend shrink scores, CCM market model, favorable. Secular volatility model, favorable. If we fast forward during the session on Friday, June 21st, basically no change in those scores, and that makes sense. Intraday today, the S&P 500 was up for the week. And the purpose of all this is not to say everything is fine and the market's never going to pull back again. To the contrary, pullbacks are 100% normal and to be expected. Data on your screen based on S&P 500 activity between 1928 and 2023. 3% pullbacks, 5% pullbacks, and 10% corrections are normal. So if you want to stay with the longer-term trend, you have to be comfortable with normal volatility. So for us, this type of drawdown would be a mitigation 1, and this type of drawdown goes into mitigation 2. We're not making any assumptions about what these scores will look like next week or in 3 weeks or in 3 months. We trade the chart in front of us. And if the market starts to deteriorate in a material manner from a long-term perspective, it will unquestionably show up on the charts and in the data and in these model scores. We could present to you numerous breadth-related studies that are concerning, and there's nothing wrong with that because that helps us keep realistic expectations relative to how markets operate in the real world. But we can also find positive studies. Based on the study on the left side of your screen, subsequent S&P 500 performance from a historical perspective, market was higher 83% of the time 2 months later, 3 months later, 6 months later. The average gain looking out 6 months, 12.83%. The average gain looking out 1 year, 26.56%, with a win rate of 100%. That doesn't mean the market's going to go up. The point of showing this, not every single study and every signal that we have today is negative. And if the market consolidates its gains after a move like this on the right side of your screen, that wouldn't be surprising. If the gains were much more muted between now and a year from now, that wouldn't be particularly surprising. But the point is, the longer-term trend does not seem to be in doubt based on anything that we know today. Which means, from a probability perspective, much like this 10%-ish drawdown here in Q4 of last year, we would expect drawdowns in the present day, at least from a probability perspective, to be followed by higher highs and higher profits. It's not a prediction. It's based on assessing the odds of good things happening relative to the odds of bad things happening, looking out 1 to 3 years. And our models and a weight of the evidence approach looks at multiple time frames, not just longer-term time frames like this monthly chart on your screen. This is during the trading session on Friday, June 21st. This is the 8-day, the incredibly fast and volatile 8-day moving average all the way out to the 50-day moving average. Present day over here really doesn't look anything like this concerning rollover look here during the early to mid stages of last year's correction. And the present day really doesn't look anything like this period in here with the moving averages tightly clustered together and price bouncing up and down. In fact, the upper right-hand corner of your screen still looks more like a favorable turn period, similar to this turn and this turn. It doesn't predict anything. It just tells us right now, even on relatively short time frames, we don't have a lot of evidence in hand that says we should be overly concerned. And even if we pull back in this direction, this could act as potential support back here. Longer-term goals require longer-term thinking. And we all know, if we're going to use all of this effectively, it's incredibly important that we keep an open mind about a wide range of outcomes, from wildly bullish to wildly bearish. And the only way that we can do that effectively is so we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.